Hello traders, it's Thursday, January the 23rd. This is John Kicklighter, Chief Strategist for DailyFX.com, here with the FX market wrap-up for the past 24 hours of trading, and an out for what we can expect in the 24 hours ahead. This past 24 hours was notable for some volatility in very particular pairs, but more specifically with very particular currencies. Some big moves were noted on the pound pairs, the Canadian dollar pairs, and the Australian dollar pairs. A lot of activity that was instigated by a very particular round of event risk. All right, we did have, I would say, Wednesday's peak in volatility or peak in fundamental event risk, and that was kind of playing or catering towards the kind of market conditions that we're currently facing. We don't really have the conditions that would be very supportive of meaningful trend development, but we certainly do have the kind of conditions that would be exposed to high-level volatility. All you need is a good catalyst to get things moving. That's exactly what we got in the event risk that we see here, and we will look through these pairs because there's a lot of opportunity that we are going to derive from these developments and potentially a number of false starts that are probably drawing a lot of us in. But the top event risk through this past session, all right, it's difficult to say exactly which one of these pieces of data will carry the biggest level of follow-through. All right, we'll have to see. I don't think that much of this can actually have a very tangible, lasting influence through the medium term, but all of these major event risks actually have a very substantial impact on the fundamental bearings for the respective currencies. So, what were we looking for? The Bank of Japan rate decision. All right, we'll start there since that is the beginning of the, or essentially the first major event on my calendar here. The yen crosses were surprisingly amongst the most inactive to that event risk. The Bank of Japan actually came out and suggested that they would not be changing their policy, although remember, no change to their policy bearing is actually keeping to a very substantial QE. In fact, as a percentage of GDP, the Bank of Japan's QE is the largest of the major central banks. All right, so they are doing quite a substantial move, but that might not matter because, as you can see, simple continuation with the established program that's already there might not be enough anymore. Since the beginning of this year, we've seen these yen crosses, and we'll use a representation of the dollar yen, have essentially met their tops and subsequently started to pull back, though it's not necessarily a true full-scale reversal, much to the chagrin of people looking for those reversals on pairs like euro-yen, which has great potential if it were to get that full-scale move, but simply a lack of follow-through. All right, I know there's a lot of bulls out there and there are a lot of speculative bears, but we need very particular conditions for each outcome, for each meaningful drive. We need to have certain circumstances met, and we have not met them. So with these yen crosses, we are looking, and I've established a relationship between all of them so you can see how they've moved in terms of their essential floors in the beginning of this pre-QE speculation, which began way back in September of 2012, because there's a lot of build-up into that QE1 program that they had, the open-ended QE program. But you can see that they have more or less stalled at their heights. All right, and we've had a little bit of retracement. If you want to see continuation, there certainly is the catalyst to keep it going. We have the Bank of Japan stimulus program expanding at a remarkable pace. All right, here's the dollar yen versus the BOJ's balance sheet. Now this is growing and growing exceptionally quickly, but it might not be enough to establish a similar kind of movement here. All right. What the market is looking for is confirmation that the Bank of Japan is going to upgrade its stimulus program in April, as was originally expected, and that it would be of a material size to generate the kind of similar influence that we had in the lead-up and follow-through after the first program. All right. Well, we just had the BOJ rate decision this past session. They didn't change anything. They didn't really give us any kind of meaningful upgrade. In fact, they said that they still expect to hit their inflation targets by their intended date, April 2015. They see it, the CPI figure, the benchmark CPI figure, at around 1.9%. All right, and they're a little bit concerned that their wage growth is not matching CPI. That means that while prices of goods are accelerating, Japanese ability to afford them are not. All right, that could lead to an economic problem, and this is putting some traders at ill ease. They're seeing potentially some kind of concern that maybe they shouldn't upgrade the QE program. There's a good probability that indeed they do upgrade the QE program, but as you can see here from pairs like dollar yen, right, who has great potential to the upside because not only do you have the yen depreciation, but you also have the dollar talking about taper. You can also make similar assessments of pairs like pound yen. All right, where the pound, and we'll talk about this in a second, is seeing interest rate expectation upgrades. Or looking at the high yield currency pairs like the Aussie yen or Kiwi yen, where we're seeing yield speculation starting to build. And these are the biggest carry trades you're actually going to get on the yen crosses. All right, but as you can see, they're struggling. They're struggling to get follow through. All right, and that's because of the concerns related to the Bank of Japan's commitment to extend its stimulus program. Furthermore, for those that are looking for the reversals, all right, and yes, there is plenty of potential should these yen crosses be pitched into a reversal. All right, not just the euro yen, although that is perhaps one of my favorite because the euro is not flashing the same kind of positive bearings as pairs like the dollar yen, but if you are looking for a yen cross reversal, it needs to have something that offsets this pretty consistent trend, kind of like the S&P 500. Right? We know that the S&P 500 is charging forward and has been charging ahead for years. Right? This is a well-trodden trend, and the markets are not just going to reverse course for no reason. You need to encourage concern. You have to foster fear. All right? And the same kind of fear that you would see in the S&P 500 or the Nikkei 225 would need to be realized by the euro yen, because you tap into fear, risk trends. All right? And what is absolutely essential for yen crosses to continue to perform is a sustained reduction in volatility. Here we have Aussie yen, for example, versus the FX volatility index. Let me flip it upside down so you can see the relationship. You need low volatility in exchange rates because the carry trade that these pairs generate is extremely small. All right, so the tolerance for volatility in exchange rates, which can, if you had a pullback, imagine if you're long euro yen where the carry trade is non-existent, actually negative. Imagine if you had a pullback on the euro yen of maybe 100 pips. It could wipe out months of carry. So there's not much in the way of confidence in just holding these pairs. If we start to see volatility pick up, not only would that undermine general risk trends, and you all should be very familiar with this chart by now, the relationship between VIX, which I flipped upside down, and the S&P 500. Once we see these fear levels or anticipated volatility levels pick up, that starts to erode those traditional buy and hold kind of positions, like equities and like the carry-based yen crosses. All right, but we still need risk aversion, and that hasn't presented itself either. So these yen crosses, be very cautious with. And if it were 5 years ago, I would say it's worth just sitting on a long yen cross waiting to see if it breaks lower because you can collect carry. But most of these currency pairs right now do not offer us much in the way of carry. Okay, so these yen crosses were the most disappointing of the fundamental catalysts, but there's plenty to offset it. Much more interesting was the CPI, all right, from Australia. This led to a considerable rally for the Australian dollar across the board. We did have a bounce in the Aussie USD, and actually I took that opportunity to institute a short trade. So I've gotten in short at 88.62. All right, placed my stop approximately 100 pips higher. So I'm looking to find a continuation. All right. Now the concepts here are, or the scenarios, if you will, are the same that we talked about essentially last week when we were talking about the fundamental scenarios, Aussie USD. All right, what if risk appetite rises? Well, the follow-through is probably going to be relatively limited because we were talking about limitations to really buy undervalued assets at this point because most of them are very expensive. Also, the Aussie USD has essentially run a negative correlation to benchmarks like the S&P 500. So I'd have to put that at neutral, although it could also be construed as bearish. Let's talk about risk aversion. What happens if risk aversion kicks in? What happens to the Aussie dollar? Aussie dollar drops, bearish. What happens if we focus on monetary policy? Right? Well, we're talking about the Fed actively tapering, and that will win precedence over the Australian dollar, which is still being considered for a possible follow-up rate cut. However, this past session we did see that the fear of a RBA rate cut has diminished significantly because the CPI figure came out at substantially better 2.7%. Okay? That is above the RBA's midpoint on its range for inflation, and you certainly see a little bit of the early speculation for a eventual rate hike. Might not happen in the next couple of months, but we are starting to see the evidence to support speculation in that forecast. And remember what I said. It's not who's the most hawkish at the time, which is somebody like the RBNZ or a central bank like the RBNZ. It's more about who has the biggest change ahead of it. All right. So if the market is positioning in a very dovish manner for the Australian dollar and the RBA expectations, and they all of a sudden change to neutral or change to further to hawkishness, then you're talking about that's where the currency move comes from. That's where the change in positioning leads to change in the exchange rate. All right. So we have a lot of potential here, but this potential has been residing here for some time. It takes time for the masses to become cognizant of the same thing. All right, but nevertheless, the Aussie dollar did show some pretty significant short-term gains. We are looking at pairs like Aussie yen, all right, which extended its bounce back up towards that 92.50 level and a little bit beyond, but it didn't really follow through on that move. We also had Aussie CAD. Huge rally. All right, this is where we see the yield differentials really play through because the Canadian dollar was substantially docked over the same period, and the Aussie Kiwi also had some significant gains. We were looking at pairs like the Euro Aussie and Pound Aussie as well. They did have pullback, but they couldn't hold on. This brings us to the pound. The pound was arguably the biggest mover on the day because we were looking at a combination of the jobless claims or the employment data and the BOE minutes. Now remember how I color coordinate these. These are a reflection of risk trends, all right? How it influences risk appetite. So the job figures were actually much better than expected. In fact, the unemployment rate dropped to 7.1%. This is significant because the Bank of England's forward guidance target for discussing an eventual rate hike is 7%. All right, so they got there much faster than they expected. This builds the possibility of rate hikes in the near term for the Bank of England. So that is negative for risk because stimulus helps people or encourages investors to take on more risk. Rate hikes unnerves unnerves global concerns. To try to mitigate these concerns, the Bank of England said that they did not see the need to move immediately once that 7% threshold is met. However, this has happened far too quickly. And we have seen that they'll probably need to adjust their forward guidance. I know they're actually scheduled to meet or to release their quarterly inflation report on February 12th, and they're going to have to change something because it might have a period of wait and see between hitting that 7% target and actually moving on interest rates, but you can't wait for 6, 9, 12 months and not have a response. Otherwise, forward guidance is losing its influence. It's essentially meaningless, and that reduces the market's confidence in the central bank. All right, so this is very remarkable. And it did lead to a very substantial rally for the British pound. Pound dollar, instead of playing out that head and shoulders pattern, which I wish would play out, but hey, we can't get what we want. We have to just trade what's in front of us. We had a break to the upside, breaking through that shoulder. We have not taken or overtaken the 2014 high so far. We did essentially have a high, swing high of 60, just above 166, but we are very close to it. All right. The pound trade that I had was risky going into the rate decision. And as I said in my strategy video, I would most likely cut the position before the release, and I did. I cut it for a 20 pip loss, which is not insignificant because we're talking about pound pips here, and I readied for a possible rebound if that was going to be the case, or a break to the downside. As it would happen, it ended up being a break to the downside, and I was filled at 82.10. So this is a short that caters towards the pound having strong interest rate expectations, and further supported by this. It also is supported by the negative euro outlook that I have, but also the technical bearings. We're breaking through the floor of a trend channel, or a couple of wedges here, and that is itself a combination of very significant fundamental development. Now, as for other pound-based pairs, we did have some big drops or big rallies in pound Kiwi and pound Aussie. You can see this morning we're actually now above 87.50 on the pound Aussie, and this is actually the pair that I said would probably move further because the Aussie dollar's interest rate outlook is not as robust as the Kiwi dollars, and you can see we're putting in further progress here. So pound rate forecast versus Aussie rate forecast, you see who wins, but not necessarily for the pound Kiwi. Now the surprise of the day would have to be, without doubt, the Bank of Canada. All right, while they didn't change policy, they did suggest further back off of threats to the to a hawkish turn. They suggested that they weren't going to try to change monetary policy, and that they weren't necessarily going to intervene on behalf of their currency. They weren't concerned with it. In fact, it was helping out exporters as it dropped. So that was an interesting response, huge response, and much more than I had expected. Dollar CAD surged. We are now at multi-year highs and continuing to run forward. We have this 50% fib up here at 112.30, so that would be a next major target. But that wasn't the only move. We talked about the Aussie CAD, big rally there. I think that the most interesting CAD-based pair, however, and one that I might trade here, is the CAD Yen. All right, coming up to this trend line floor. Remember what we say with the yen crosses, CAD Yen certainly falls within that category. If you want to break to the downside, simple declines from the counter currency aren't going to work. All right. If that were the case, you would see Euro Yen had broken its neckline a while ago. Or we would have seen the Aussie Yen, which has had its own trouble, would continue lower as well. But they haven't. In fact, look at the Aussie Yen. Nice wedge formation. Look at the CAD Yen. Nice wedge formation. All right, they are very similar. So will we have a trend line hold and reversal here like we did with the Aussie Yen? This is probably a trade I'm going to take, especially if it holds. But looking for a hold is going to be a very important aspect here that would tell me that this is indeed a level that the markets are going to respect. So keep this one in your view heading into the next 48 hours of trading. All right, this is going to be an interesting one, and I know not many people watch this, but this one is worth considering. Now, the CAD Yen is not the only setup that looks provocative. I'm also becoming more and more interested in the Euro USD. Now, I told you this pair was something of a problem, and actually I talk about this one in today's strategy video, which we cover imminent breakouts. All right, so we definitely have a number of imminent breakouts out there, but doesn't necessarily mean that's going to happen, or it doesn't necessarily mean it's going to happen in the next hour, or maybe even the next day. And furthermore, and more importantly, it doesn't necessarily mean that we're going to have strong follow-through on a breakout. So while you can get a break, it might not necessarily be the best tradable development. This euro dollar looks like a good technical setup. This is a 4-hour chart. You saw a very meaningful trendline break here, multi-month trendline break when we slipped below this level, about 136. All right, and then we worked our way into this now descending wedge formation, which can be a possible pullback, correction, and follow-through, or it can be the kind of consolidation to extended reversal. But we have to wait for that break, and we have to wait for that follow-through. You can see in this congestion, though, that this is not a market that's very easily persuaded to follow through. Furthermore, you can see that we are now even in a tighter situation with the congestion here. Right? Rising channel, 4-hour chart. We are now spanning this tight wedge, and we have a tighter congestion. So we might get a breakout. All right? Almost certain that we get a breakout. So breaking this channel, we might have. But would it necessarily lead to a very strong movement on the break? No, not necessarily. We do have some scheduled event risk that is worth taking note of. All right, you're going to have the Eurozone PMI figures, which are essentially leading GDP numbers. So they do have a very material influence on expectations for the Eurozone economic health, but also the interest rate forecast. And when we talk about interest rate forecast, we're talking about the possibility of new stimulus programs from the ECB, because as we said, there's a lot of capital going into the Eurozone, and it's driving these yields on Eurozone periphery countries to exceptional lows, to record lows. Right? So the market is essentially pricing in little to zero risk in the Eurozone, but there is certainly risk to be had there. It's just not being appreciated, as investors are scrambling, trying to search for whatever yield they can find. This is a very risky position to be in. We can eventually see these concerns arise and expectations for more stimulus from the ECB recover. But if the market's not willing to move on that, which it has been reticent to do so to this point, then it doesn't necessarily present us with an active trade. All right? Because if there were a big euro drop-off, it wouldn't be just the euro dollar to be looking at, though that does have very good technical bearings to it, as well as the Fed taper speculation looking good for the dollar side. But I would also be taking that euro-yen head and shoulders pattern much more seriously if we had a material euro selling, but we don't. Now the other side of the euro-dollar pair is the dollar. The dollar has great potential in not just from pairs like the euro-dollar or the dollar-yen at that trend line resistance or the Aussie-dollar after that pullback, but the dollar in general looks like it is ready for a more meaningful move. It's been kept to this channel for months, and activity levels have dropped to exceptional lows. This is tied in to risk just as much as anything else, and a big risk-based move could have a material impact here. All right? And as it happens, there is very likely to be a break from our benchmark here, the S&P 500, through sheer necessity, because we have a terminal wedge where we will have, in essence, a technical break that has to occur. Doesn't necessarily mean you have to have follow-through, but you have to have a technical break. All right? If we could have a technical break with follow-through on risk trends, the theme, not necessarily the index, then we could have a much more significant move from the US dollar. But as it happens, where are we going to get the influence for that? Where are we going to get the drive for that? That's an important piece of data, all right? Manufacturing activity for the U.S. is important. Certainly, U.S. home sales are important. A good measure of safety demand and inflation hedging would be the TIPS sales, but those aren't major market movers. Neither is the event risk that we schedule for Friday. Actually, Friday is going to be a very light day for fundamentals. The big stuff happens next week, particularly the FOMC rate decision on Wednesday. All right? Now, we are not likely to see the wedge on the S&P 500 hold up that long. We're definitely going to get a break. But where will we go from there? It's likely to be a break that is going to stall. All right? It might show some immediate follow-through and excite a lot of traders that have been waiting for this move, but the follow-through is going to dry up pretty quickly, and it probably won't spread very willingly to the FX world. So the dollar's not going to get that risk-based movement that it would usually look for. All right? So we have to align all these expectations, but as it happens, we still have to stick with the bigger term themes. Risk trends is not one of them. However, what we can still look towards is relative monetary policy, taper speculation versus the RBA on hold, or even the yen crosses potentially getting a push forward if the status quo kicks back in, right? Or we can look at something like the pound crosses, not necessarily the pound dollar being the best one, but euro pound, or the pound crosses like the pound Kiwi and pound Aussie. These are exploiting relative monetary policy. Bigger market movers, right? Bigger, more consistent themes that are proactive now. Of course, most of the volatility resides in counter trend moves, especially on over-leveraged trades, which all of risk is, and of course all of the yen crosses are, but unless you have the correct ingredients to make that happen, it's just a pipe dream. It won't actually come true, and it's not something we can actually trade. All right? So we can have our scenarios for those themes, but it doesn't necessarily make smart trading. We have to stick with those setups that are more consistent and a higher probability. All right. I'll update you once again for the next 24 hours after we've gone through some more meaningful event risk, including those Eurozone PMI figures. Until then, good luck trading out there, and I'll talk to you tomorrow.